Good evening, ladies and gentlemen. Welcome to the Mutual Fund Show on Business Today television. It's a special day today. We have a very special person, Mr. Anil Ghelani. He's the head of passive products at DSP Mutual Fund and a very well-known face in the market who advocates the use of passive equity funds to generate long-term growth in India, which traditionally has been a market dominated by equity diversified funds. And it's only lately, in the past 3 or 4 years, that passive funds that track indices such as the Nifty and the Sensex and the FMCG index or the pharma index have become popular simply because a lot of new investors who've come into the market over the last 3-4 years have followed the US model where primarily amount of money goes into passive funds. Anilji, welcome to Business Today television, and it's such a pleasure to be in touch with you after so many years. The benefits of passive funds are known to all: low management fee, near index-like index returns which the fund tracks. Over the last 2 or 3 years, we've seen the popularity rise dramatically in India. What are the 2 or 3 things you think contribute to this rising acceptance of this vehicle in Indian portfolios?
I think one of the key things why passive funds have been growing, I believe, is the way in which the market has been evolving. So I believe as we come up with more and more complexities in the market, this kind of simple and easy to understand portfolios, funds which have relatively low cost and yet more simple to understand, which can give investor a very clear-cut understanding about their risk and expected return outcomes, that becomes a very good way or reason for penetration. Another thing which I believe has taken place is that, in simple example, certain large cap, especially funds, had been finding it more and more difficult to outperform the underlying index, which led to a lot of visibility given to index funds.
Okay, so these are the 2 or 3 reasons why popularity of passive instruments such as index funds is rising in India. Of course, as Anil put it very succinctly, over the last 2 or 3 years, we've seen this emerge as one of the fastest growing segments in the Indian fund universe. The 2 largest funds in India on the equity side are the Nifty ETF and the Sensex ETF, and both of them happen to be passive funds run by the State Bank of India Mutual Fund. So there is no denying the popularity. Anil, when you deal with HNIs, and I'm seeing a lot of data that you've sent us, that ultra HNIs have actually taken this new instrument to heart, and a lot of money is getting poured into it. A lot of money is also coming in from EPFOs. You know, is the construction of the index one of the reasons why the popularity of such investment products is rising in India?
See, construction of the index definitely is important, and in that there are various developments which keep happening on an ongoing basis. So you gave the example of, let's say, for example, Nifty 50 and Sensex. This is a bellwether, traditional market cap oriented index and most easiest and simple form, purest form of indexing. Now on that, some other development keeps taking place. For example, a very simple strategy which evolved on top of this was equal weight. So let's say, for example, Nifty 50 equal weight strategy. What it does is that it gives 50 stocks equally weighted, so 2% to each stock, and a different strategy with different risk and return outcome gets created. Now, if we look at this equal weight strategy on Nifty 50 and compare it with Nifty 50 over the long period, it has outperformed by about 2% CAGR. So sometimes it's kind of, you are right, absolutely. The design of the index also helps a lot in enhancing the investor's potential for returns or reduces the potential risk. So that gives a good structure to the underlying portfolio or to the underlying strategy, whereby investor gets a high level of comfort that their fund will be managed, point number 1, in passive style, so no human bias, But point number two, with some little bit of differentiated so-called rule-based active style, such that they can get a sort of best of both worlds. So I feel that is going to be the now next big driver. Already we are seeing in the markets, but maybe that will be the way forward, which will result in more penetration and more adoption.
Right. Anil, we've been fortunate to have somewhere like 25 to 28-year history of equity mutual funds returns in India. And we've seen that, the diversified category, some of the best funds have appreciated anywhere between 18 to 25% CAGR over the last quarter of a century. When you look at returns generated by funds that passively track the Sensex and the Nifty, the compounding has been to the extent of 12-13%. How do you, as a proponent of this category, justify it to people like me who want to take benefit of India's rising aspirations, growth percentages, and opt for equity diversified funds, where the fund picking ability of a fund manager gives you that extra alpha?
Very true and very perfectly said. See, structurally in Indian markets, the actively managed funds have been able to deliver alpha, but like you said, the past one decade, so the decade from 2000 to 2009, that period, and then the decade after that, like the more recent decade, there has been a marked shift in terms of the alpha generation. So without taking any individual fund, but if we take an average of, let's say, all large cap funds put together, and we see their alpha over the previous decade, it was a good comfortable 4 to 5%, I would say, over a 3-year, 5-year rolling return basis. But that same number, if we see in the period later on, like 2010 till 2000, till recently, that alpha has little bit shrunk, and it's maybe like around 0.5 to 0.75%. So, point being that yes, no doubt, there is a potential to generate alpha or outperform the index, but that has been gradually reducing over the time. And second thing is that the divergence between the worst performer and the best performer in active category has become so large that sometimes if as an investor you end up being invested in one of the fund which was the worst performer and not the best performer, you
Yes.
tend to have a huge gap between the two.
Absolutely. Well, that is a topic for some other discussion. But Anil, let's focus on constructing a portfolio. And I'll be very honest with you. When we look at overseas markets, especially in the US, typically Indian investors go for index funds that are tracking the NASDAQ or the Dow overseas. And typically that has been a very good diversification strategy to get a foreign component in your portfolio. DSP itself offers about 7 to 8 passive investment vehicles, and of them 2 or 3 are commodity plays. So if you are trying to construct a portfolio around passive instruments such as index funds, how do you typically go about it?
See, passive funds, both index and ETFs, can be a good building blocks. So like you said, there are certain funds which can give you market cap based allocation. Some will be commodities, some will be sectors, like very rightly you said, recently we launched a couple of funds which one is focused on IT as a sector, one is focused on banking, then within that only private banks, PSU banks. So depending on your investment view, let's say for example, you watch a latest news flash or you watch some update regarding changes in view on public sector undertakings and you want to express that view in investment portfolio, you can immediately go and build up that building block. Let's say for example, buy a ETF which will give you exposure only to PSU companies or to PSU banks. Yes. Or you are having a way in which you want some commodities, some large cap and some mid cap, you can create a good all-round holistic portfolio and maybe run a regular SIP to create the gradual accumulation across that. So one can think of these as building blocks which you can pick and choose as per your exact investment view, which in a normal case, let's say actively managed fund, you are giving that judgmental factor to the fund manager that she or he can decide based on this particular changing market trends and positioning the active fund. Here, you are in the control whereby you can do it yourself, basically.
Right, Anil, there is absolutely no doubt in my mind that the coming decade, especially in the universe of mutual funds, belongs to passive instruments. We've seen amazing popularity of the Nifty ETF and the Sensex ETF, and in the last about 2 years or so, you very rightly mentioned that the PSU Bank ETF is doing phenomenally well, and I speak to a lot of product developers such as yours. There is a host of asset management companies that are coming in who are automating distribution, automating marketing, and coming with passive instruments where the cost of management of a particular index is so minimal that overall returns get really well once you start compounding them over 5, 7, 10 years. Tell me, what are the product pipelines within DSP Mutual Fund looking over the next 2 or 3 years when it comes to passive instruments? What are the new things that the Indian market can expect from AMCs such as yours?
Super point. See, I think that there is a lot of innovation yet which can happen in two areas. One is, like we spoke, smart beta. So combining active management thinking, packaging it with certain predefined rules, and converting it into an index, whereby during the formation of the strategy, a lot of deep research and analytics have been put into the place. But after that, then there is no human bias in terms of managing that portfolio. So that is one category where, for example, today we have got funds with different factors like momentum, volatility, uh, uh, growth, value, and then there can be multiple combinations of these. So there is a huge potential for that. And other area, I believe, would be in commodities. So as of now, under the prudent regulatory framework of SEBI, certain commodities are already permissible. Maybe in times to come, little bit more can be feasible on that front. So I believe these two will be the more newer areas where this kind of development can happen. Other than that, no doubt the plain vanilla, pure and simplistic form of the pure index funds will continue. I strongly believe this will be the main reasons for enhancing penetration of mutual funds. Today, we still have around 3.8, 3.9 crore unique mutual fund investors. If we want to increase that, this could be the first port of call. So that will evergreen type product will also remain. But newer areas, I think this will be the key things to look for.
Right. I am in wholehearted agreement with you when it comes to market penetration being driven by passive funds, simply because one, they are a fabulous instrument to track, very easy. Of course, you have to keep the tracking error in mind, but like I said, that's a topic for a different discussion. The other fact is that cost management is really very easy when it comes to passive funds. And Anil, we were just having a conversation with the chairman managing director of National Stock Exchange, and he said that a lot of fresh product innovation is coming in from the exchange side, where a lot many indices will be introduced on the futures and options part. You know, government bond indices, interest rate indices, electricity futures, and of course a host of other indices that are already being tracked in the cash markets. This is obviously a very, very big growth areas for AMCs such as yours to mimic a particular sector and then launch a fund.
No, that's a very good point. But I believe, see, there are point is correct, but just one thing we have to keep in mind that launching an index by an index company is different from being able to launch an index fund or ETF or that. So some of the examples, what you mentioned, let's say energy futures or let's say certain other categories, launching a index by an index provider is comfortable and easy, they can do it. But as of today, we as a fund house, as a AMC, are not permitted to launch a fund on these type of underlying exposures. Yes, certainly that is the future, and in maybe couple of years to come, it will open up and we will be able to launch. But I believe right now it will still be a little bit slow on these kind of innovative underlying instruments. So wherever there is instrument which is pure listed equities, listed
Yeah.
fixed income, and these currently two commodities which are enabled, on that different combinations will keep evolving. Let's say we will soon see hybrid index funds, which will have a combination of equity, fixed income, maybe commodity. Today we have either a
Yes.
equity ETF or a fixed income, but we don't have a combination or hybrid. So we are working on those kind of innovative ideas definitely, which we can bring to the investors shortly.
Absolutely. Just as the equity diversified category has a flexi cap subheading where the fund manager is allowed to invest in any kind of market capitalization where he sees the maximum possibility of growth, the future, how should I say, expressions coming in from the passive side could be a multi-asset passive fund, and I'm sure that's going to be a very exciting part of the journey. The other thing that not many people realize is that once you buy a passive fund via the ETF and have it in your dematerialized account, you can also raise funding against that. Almost
Perfect.
70 to 80% value is available as funding for your either trading activities or even investments. That is one of the features that is not very well advertised, but those who are ultra Chinese and even bigger institutional players actually use this as an instrument to raise further funds. Anil, we've
I will
had
secure for 1 minute, even to certain extent of up to 90%. There are certain like liquid
absolutely.
up to 90% you can. So it's a very good point, and thanks for highlighting. You're right. It's not sometimes very well broadcasted and made aware of. So really appreciate. Good, super point. Yeah, yeah.
Yes, and you can also invest in precious metals via passive funds, and they again can be used to raise funds via your demat account. These are two or three things which obviously don't get talked about because people are so enamored with the ease of dealing with an ETF, and of course the returns that come in fantastically well. Two of the best performing funds in India over the longer period of time have actually been local rupee ETFs that have invested in the Nasdaq, but we'll discuss that separately. Anil, one of your many abilities apart from handling passive investments has been stock picking and holding a crystal ball to where markets are headed. So let's shift focus to what is happening in the markets as of now. Tell me, what is the view? Interest rates are likely to remain, how should I say, strong in the US economy for the next couple of quarters, and that is not going down well either with global equities or global strategists. What is your own personal view of sentiment in Dalal Street?
So I think that today you are absolutely right that from global markets perspective, especially if you look at US, there is a chance of continuing little bit higher interest rate. The second such global overhang is in terms of European zone or the many of the countries in Eurozone, which are under a so-called financial contraction or some sort of even degrowth, as well as certain parts of China, basically, which we are seeing under pressure. So structurally, from a global growth perspective, there are multiple drivers of global growth, but these three engines out of the multiple drivers are firing a little bit slow. So I feel that structurally in the Indian equity markets right now, we need to look at three things. How I look at it is CFE, corporate earnings, flows, and event risk. So corporate earnings, I feel, have been good. We have seen about 30% growth from over the last 2 years. We are today still Nifty 550 as a broad index. We are trading at about 23, 24 times, which is much lower than peak, which was around 28, 29 times. But still, it does indicate some bit of a good valuation. So I believe we need to be a little bit cautious in terms of our incremental allocations to equity. If you look at the flows, already in this current year, till let's say a couple of weeks back, means first 7 months of the calendar year 2023, we have seen about $15 billion worth of flows from global investors. So maybe in the next couple of months, we could continue to see the flows, but the speed will little bit possibly slow down. So with these three things in mind, the global growth event risk, the way in which corporate earnings are growing in a healthy way, but we have also correspondingly connected with the market valuations and the flows which could be a little bit slow. So with this angle, I would feel one has to be a little bit cautious in incremental allocations, find certain pockets which can do well. Certain sectors are looking very attractive. For example, auto, for example, healthcare. In certain extent, I would say this kind of investment strategy will hold you in a better stage.
Right. Anil, you have been an equity strategist at DSP, where the last 20, 22 years you've spent an amazing amount of time looking at various equity diversified schemes. Two sectors, auto ancillaries, as well as deep end financials. If you were to make a portfolio at this point of time, what are the 2 or 3 sectors that you would represent in that portfolio?
So one definitely I would hold, like you mentioned, auto ancillary. One is definitely within BFSI, banking and financials. There are certain pockets where there can be good opportunity. So select NBFCs or lending institutions definitely would find place to own. Healthcare sector, especially some part of healthcare which has been attractively valued since a while, that can have good opportunity, especially many of the US market facing generics type of businesses are in good stage. And one more area which I am looking at very closely since the past couple of months, which is sort of like a contra bet, would be allocation to IT sector.
Yes.
So while certain, many of the viewers might have a negative outlook or cautious outlook, I believe structurally most of these companies are in good shape, and especially with the current valuation levels, they feel attractively valued, especially compared to their global IT peers. So with that, definitely few companies could have little more downside left, but structurally it could be a good position to have in mind as a contra bet.
Right. And if I'm right, there is also an ETF available which tracks the Nifty IT index, but we'll discuss
Certainly,
that. We'll discuss that.
Yeah. Certainly. So
Certain.
not talking about any ETF, but like
Yes.
general point we spoke earlier, and how you correctly mentioned that these ETFs can be building blocks. So suppose if somebody
Absolutely.
is aligned with this view, they can, instead of relying on XYZ active manager, themselves go and buy that one slice of the market, own it for a tactical allocation for 3, 4, 5, 6 months, and then exit out of it. Most of these funds come with zero exit load, zero entry load, so easy to come in, easy to go out. So that's just, but good point. Yeah, perfect.
Yes. Actually, there are so many good points as far as passive ETFs are concerned that we again and again come back to the same groove. Anil, taking the discussion on portfolio alignment a little further, we've seen some of the finest results coming in on public sector and private sector banks over the last 15 years. But the top end niche, which is the 4 or 5 private banks, have somehow fallen victim to profit booking. Do you think some part of the market is thinking that we've hit peak net interest margins, we've hit the minimum possible level on net NPAs and gross NPAs, and from here the story of banking might just get a little dirty?
See, one thing absolutely right, that net interest margins can be considered that the very sweet spot which most of the banks were operating in over the past, I would say, 12 to 18 months. That gradually will taper out, because structurally when the interest rate rising cycle started, at that point of time, most banks, whether in India or globally, they immediately see the one leg of the pricing change, but the other leg takes time. So the net interest margins always look very healthy in fast rising interest rate scenario. So now if you look even in Indian markets, like around 2 to 2.5% rate of interest increase in about less than like 12 to 18 months. So the net interest margin was very healthy. Maybe we'll see that little bit, how should I say, plateauing. But structurally, on the other side, now we will possibly see a good potential on the increasing credit offtake. We will potentially see a good stabilization of the NPAs. So I would think that, as we say sometimes on a layman's term, that sometimes the best opportunities are seen when you are standing at a plateau and looking for further opportunities for growth. So maybe we can be considered as like on that kind of a plateau right now, whereby now new opportunities are being considered and scaled up. So I feel in this particular sector or this category of companies, definitely the drivers of growth will change. Maybe net interest margin expansion was the one main driver. Now that will change. Rate of take and further penetration and growth of the healthy book of business will take over. But definitely, I feel that it will be a important sector and a very favorable sector to watch. Structurally, I feel for any developing country like India, finance becomes a lifeblood, and hence both whether it's private banks or public sector banks or lending entities like now NBFC, HFCs, they will continue at least for a little bit more number of years a good growth potential.
Right. Anil, no discussion with any fund manager or equity strategist is considered complete these days if we don't take an opinion on the PSU basket. After 27 years, I haven't seen the kind of rallies that we've seen in defense stocks and now the railway theme and of course the value expression that's coming into the PSU banking shares. Does it give you sleepless nights?
No, I mean, structurally, I feel that whatever we are seeing in terms of the growth in some of these companies, a lot of it is backed by growth in the business as well. So, no doubt, I mean, I have not exactly compared 27 years and current last, let's say, I would say 27 months or like, let's say 1.5, 2 years when we are seeing a good rally. But definitely, I feel that there is certain structural changes. There is certain way in which these companies' outlook is being considered at this point of time, which is resulting in this positive rally. It's not just that it's based on some flows-driven rally. It is structural changes which are happening, which are seeing the positive trends, I believe.
Anil, you speak to many peers within the fund management industry and almost over a period of time many foreign institutional investors who come into India always take that dipstick survey with fund managers, whom I'm sure you are a part with that circle. We've seen this Goldilocks scenario coming into India over the last 5 months or so, where everything is working right as far as equity assets are concerned. But I'm sure there are some troubling points on the radar which are hidden at the moment. What do you think can be troublesome for the market over the next 6 months to a year?
See, I think structurally, like you said, over the past 6, 7 months, things have been positive, especially like you mentioned for global investors. We have already seen about $15 billion of net inflows in equity markets from offshore. So I believe that the way in which the global growth is being considered under some bit of a pressure, the way in which certain other global markets are being perceived as relatively more risky, whereas India has a stable economy, more domestic driven economy. So there is a potential for better growth. So with that angle in mind, I feel that global investors will continue to see India in a favorable way, except for valuation. Like we discussed earlier, that valuation comfort has been low. We are at peak levels of market already now. So definitely that is one area which I believe can be a concern.
Right. And Anil, when I look at my watch, suddenly 27, 28 minutes have elapsed. And I just couldn't keep track of them. It was such a lovely conversation that we had on the current popularity of passive investments such as ETFs, which has grown very rapidly over the last 2 or 3 years. And the horizon over the next 5 years looks equally bright, if not brighter still. Anil is one of the pioneers in this field, and his pipeline of products is thick and very deep over the next 5 years. We wish him all the success because it translates into lower management fee for investors, better tracking of the index, definitely easier sleep when it comes to volatility, and of course the product portfolio is so vast that all your investment needs can be met by passive funds should you choose to be. Thank you, Anil, for your time.
Thank you.
And
very kind of you. Really appreciate, and all the best to all your viewers. Thank you very much.
It's been a pleasure hosting you
Likewise.
over the last half hour.
Likewise.
So that's it.
Thank you.
Ladies and gentlemen, in this edition of the Mutual Fund Show, our guest today was Anil Ghelani. He's the head of passive investment products at DSP Mutual Fund, and it has been a fabulous discussion so far. Remember, passive equity funds are the first port of halt when it comes to a new investor into a domestic market, as also institutional investors when they deploy funds overseas. They typically buy the main index ETF, and its popularity in India over the last 2 or 3 years has increased dramatically. Do stay tuned into BTTV for all your financial news and wealth requirements. Thank you so much for your time, and have a good evening.
मैं ट्रांसपोर्ट मंत्री